right. So, hello and welcome to the Bryn Mawr Village 2025 wrap-up call and outlook for 2026. So, this acts as our fourth quarter investor call. Thanks for attending. I see that we have six or eight people here in person, and I'm sure everybody else is at work and they'll watch this thing on the recording. So that's great. We'll make sure we send that out to you. Let's see. Michael, are you able to see the waiting room?
No.
Just okay. I'll keep an eye on it then. I don't want to leave anybody hanging. So they're still coming in. Okay, great. Well, let's get started then. Um, so Bryn Mawr Village, we're having a good time with this one. And we have had a good 2025. You know, as you remember, we bought the property. We closed on the purchase of it on February the 9th of 2025. So we are not yet even a full year into it. We are coming up on that full year very soon. So in 2025, we've had many successes. Operations are performing at a very high level. Our operational team, our management and on-site team are working very well. Michael and I interact with that team very often. I mean, we have weekly meetings from this very, I'm standing right here when we have these meetings, and Michael's right where you see him now. And so we communicate very well with these folks. And we have maintained very high occupancy levels. In fact, you see over here to the right, 95 to 97%, and that's up from 88% at our low point when we bought it. Remember, we had that immediate dip, and we have worked hard to get it back up stable, and I'd say we've exceeded stable. So we're pretty pleased with that.
Yeah, and I'd say this asset is kind of bucking the trend of other multifamily assets of a similar vintage. So a lot of things that you'll see, especially like throughout 2025, you saw declining occupancies, you saw stagnant rents, maybe even rent drops. And we haven't experienced that at this property, luckily. So we've experienced the opposite, where occupancy's been going up. We've been getting close to having a wait list at points, and rents have been pretty close to where we anticipated they would be. So overall, all good news on those fronts.
Yes, definitely so. Yeah, our activity, like the leads and applications that we get here are very high. So we're pleased with that. The demand is strong. Um, so it hasn't all been easy. And I'm not sure if any of it's been easy, but we didn't expect it to be easy. But our challenges have mainly been navigating through all of the financial and procedural hurdles that some of them are market driven, but I'd say mainly the main hurdle for us has been the management of cash flow, and that's as a result of the existing debt that we used to buy it. Remember, we purchased this with bridge debt, and we're working towards the HUD refinance, which we'll talk a lot about in a minute. But the bridge debt is expensive. And so that's, it's bridge, it's temporary and for a good reason. And so we'll be happy to get out of that. The other thing was with the turnover, we turned over a lot of units. And when you turn over a lot of units and we upgrade them to market standards, that's expensive and that takes a lot of cash. So we've been working hard to manage our cash flow with vendors and everything else. The other thing we've spent a tremendous amount of time on is the pursuit of this HUD 223F loan. It's very complex. It's very time consuming. We're grateful for the experience and we'll be more grateful when we close it here shortly because it's really going to be a major positive for all of you and us and the asset altogether. And another key challenge, Michael mentioned that we're kind of bucking the national trends on occupancy and things, but one trend that we are in line with the rest of the world on is that concessions are in play. Concessions, our most common concession that we offer on this property is one free month rent with a 13-month lease. We got up to a vacancy of only 2 units. And at that point, we took away the concession and we immediately saw a dip in occupancy. I mean, we still have very high occupancy, but we immediately saw a dip and we realized that, okay, the market's not ready for us yet to take this concession away. So we put it back in. And, hopefully 2026 will see that change as a whole. So look over here now, our outlooks for the next year. So we have, we still have very stable KPIs. We expect that to continue. Let me move this waiting room here, Michael. So our objectives for 2026 will be optimization, so operational and financial optimization. How can we take what we have that we're already running successfully and make it more efficient, tighten it up here and there so that everything we improve goes straight to the bottom line, which increases net operating income. Uh, Also, asset preservation, that's an ongoing forever goal of ours. So we plan to close the HUD loan and very soon. We'll talk more about that. Cash flow, we think we can improve that again, not only through the reduction of debt service with the HUD loan, but through other efficiencies that we implement, expense controls the same way. And then we've got things like, um, upgrades to the gym and the dog park and all of these kind of pride of ownership things that we will put on a schedule and try to implement in 2026.
Think this is a pretty good summary of what you just covered.
Yeah.
Probably skip
Sorry, I
through.
don't I don't mean for the delay. I'm keeping an eye on our participants to make sure no one's leaving, but it's I just don't want to leave anyone out. Yeah, that's a good summary. Operations, kind of another good summary here. I'm very proud of our operations. I think that separates us a little bit from other syndicators or people who do what we do. That Michael and I are very hands-on with the operations. Now, not on a property and a tenant level. Like Michael and I don't deal with leaky toilets and we don't show people apartments and we don't sign leases.
Yeah, you don't want me to because it'll still be leaking when I'm done.
Yeah, that's not our strong suit. But we work very closely with property management and very closely with our CFO. And so we are all up in this stuff and we're always on the hunt for how can we make it more efficient? How can we keep the communication up? And for that, we're very proud. Again, occupancy is very high on this property. So here's some numbers. Michael, you want to run them through the numbers a little bit?
Yeah, we talked about the occupancy kind of at length. At our lowest point, we hit 88% in Q2. This is this the
Oh,
most updated deck?
yeah, yeah,
Yeah, so it's Q2 2025, not
yeah.
2023.
Typo.
That was definitely the dip that we saw when we took over ownership. And what we realized was that the previous owner was trying to keep occupancy super high so that they could close the sale and the transaction no problem. When we took over, those non-paying tenants had to eventually get out of the property over the course of about 6 months. We since, by the end of the year, got it to a really good spot. If you look at the average rents, so this is going to include the base rent and the other income, so all of the fees that we charge for pets, trash, you name it, whatever goes into it. It's about $1,210 per unit. Our target on the pro forma was 1,254, so we're at about 3.5% variance, so we're very close to the target there. And then if you look bottom left-hand corner, you've got the net operating income. So we've owned this for about 10 and a half months of 2025. So we achieved a net operating income of 1.34 million over the course of that time. And if you annualize it, if you take it on a 12-month basis, that would come out to right around 1.53 million. The target was 1.75 million. It's about an 11% variance, but we feel very confident, and we'll talk about it on upcoming slide here for 2026. The target's about 1.77, and we feel very good about hitting that number. And then you
Mhm.
can see the value in the bottom right-hand corner. So when we got the appraisal done for the HUD loan back in October, we got handed an appraisal worth 25.4 million. That was at a 6% cap rate. If you remember, we bought the property at 21.25. That means since acquisition, a mere 10 months after buying and stabilizing the asset, we've increased the value on paper by 20%, which is fantastic.
Yeah, yeah, that's a good one. Let's see if I can erase my little
Get rid
marker.
of the annotation.
Yeah. Yeah, good. All right. So close on the HUD refi. So let's see, which slide, Michael?
We have a
Uh,
whole slide on that, yeah.
yeah, let's pause that so we can just follow on the slide. Maximize cash flow, reduce utilities. Yeah, utilities are always an opportunity in this business. There's a couple people that are on this call that were on the previous call, and same at the other property. Utilities are a big expense, and they tend to be messy to track and reimburse and all these things. So we're always on the hunt for how to make those more efficient. And there's lots of money on the table in every property at all times with that one. Um, yeah, property improvements. Again, I told you that we're going to focus on some of these amenities and give them some fresh updates. Always in pursuit of that pride of ownership. And Michael, if you want to hit these 2020, now these numbers are outlooks for 2026.
Yep, these are the targets for 2026. You can see we want to keep that high occupancy 95%. The average rent, so right now the multifamily space, you don't see large increases in rent coming year over year at the moment. It's been relatively stagnant, if not deflating year over year for the past like 12 to 18 months. So we're at around, Ashley, what was the other slide? 1210? So
Yep.
we're suggesting a modest increase to 1280 for 2026. The reason we think we can achieve that is because of the other income categories. So it's not necessarily the base rent, but the tenants that we inherited from this property, they really weren't being charged any sort of fees along with the base rent. So for the average tenant, they might have been paying $30 a month in additional fees on top of the rent. Our base package with our property manager, they institute a program that adds fees of about $110 per unit on top of the base rent. So when you layer that in right now, we're at about $70 per tenant because it's meshing the two programs. And when we stabilize that, once we've turned over the units once in all cases, they'll all be on that $110 plan, which we believe will allow us to achieve the average rent here about 1279. If we do that, which we think we will, then the net operating income target for the year is going to be 1.77 million. And then if we're conservative on the cap rate, so the appraisal we got was pretty aggressive on the cap rate. They used a 6% cap rate. We're being more conservative on the estimate in the bottom right-hand corner here, saying that with a 6.5% cap rate, so a slight conservative approach there, we believe the asset will be worth even more by the end of 2026 at 27.2 million, a 28% increase versus the day we bought it.
Yes. And if we did use, by the way, if you use in the calculation, if you use the cap rate that the appraiser used on the most recent appraisal, if you use a 6% cap rate, that value's like just barely shy of $30 million.
Yeah.
So
And you
it's
you run
huge.
into nuances like this when you do this all day every day where the refinance appraisals are going to be better than the cap rates at sale. So we're trying to give you like a realistic view of, if we were to go sell the asset today, what could it command on the market? And that's going to be slightly different than what an appraiser gives the value at.
Yeah. Good. Good, good, good. By the way, national trends, Michael hit on that a little bit. I was actually listening to a brand new report from Ivy Zellman and her group today. If you guys like that kind of stuff, she's a great resource. But the national trends are occupancies for multifamily are in the low 90s. There's concessions in place everywhere, and rents are mostly flat with either a slight positive or a slight negative, but there really aren't any significant rent growth, save for a few, just micro markets. But for the most part, it's very flat. So our occupancy is definitely outperforming. Oh, on the rent renewals too, we work hard to renew existing tenants. We're not looking to just run a tenant out and have a vacancy that we have to replace. So even on a renewal, we are able to increase our gross income because the fees get put into place. So renewals are great. We get to save on the turnover and the vacancy, but we get to increase the rent also. All right, so this is the slide on the HUD loan. Now, this is a really big deal, and we've spent I don't even know how many
Right,
hours.
8 months.
Yeah, 8 months worth of hours of, I mean, that might be actual work hours. I'm not sure, but it's a tremendous like heavy lift as far as the 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 journey that we go on to get this loan. And it's fabulous. I mean, we're so excited. So we last Friday we got our firm commitment letter from HUD. So that means that HUD, they sent us this 46-page letter. It's a 2-page letter with 44 pages of amendments. But the letter basically says that, hey, we're going to give you this loan, and these are the terms, and this is what you have to do to get it. And what we have to do to get it are things like, update our legal, update the survey, you know, that kind of stuff. So we're well underway working on that already. We would anticipate closing no later than March 15th. So mid-March, which is what, like, I don't know, soon,
45 days.
month and
Yeah.
a half. Yeah. Um, so key deal terms and stats, fully funded reserves. So HUD requires that we do number two here is all critical repairs completed. So we have the list of repairs we have to do. For example, one of them is we have to install 608 GFCI outlets. And I think it's right around the same number, 600 or so additional smoke detectors. I mean, we already have smoke detectors, but they tend to be overkill, and we're fine with that. It's a safe asset. Now, in addition to that, at closing, we have to put with them $686,000 in cash that is our reserve fund, fully funded reserves. And the reason for that is this is a 35-year loan. So this is a 35-year amortization and a 35-year fixed interest rate. And HUD wants to make sure that we have an asset that is in good shape, and we have the cash to make sure it stays in good shape for the whole term of the loan. Now, as an investor, and we're right in there with you as far as being an owner and investor. That makes us very comfortable because we know that it's highly unlikely that this thing is going to fall into disrepair because we've got the money, we've got a schedule that we've got to stay on with HUD to stay in compliance.
Yeah, and that those reserves are paid out of the loan value. So it's not like we're coming to the table with those funds. It's actually paid out of the distribution that HUD gives us. And it goes into a separate account. And every year we do certain repairs that are pre-agreed to.
Yes. Yeah. It's like a
Autopilot feature.
yeah, it's like an autopilot feature. Just think of it this way. If you didn't have this requirement, and you have to have the self-discipline, if you will, just like at your own house. You know you're going to need a roof at some point and a new HVAC at some point and a plumbing leak. Well, you have to have that self-discipline to put that cash aside so that when the time comes, you can fix it and you don't have to live with no air conditioning. In this situation, that's all part of the package. So that autopilot feature means that we don't have to worry about that. And when the time comes to replace things, we don't have to come asking owners and investors for a capital call. The money's already there.
Yeah, and the big dollars and cents point here is that third bullet point of the debt service reduction. So our bridge debt, like Ashley mentioned, it's expensive, and it was meant to get us to this point. And now we are at this point, and we're going to execute the proper long-term permanent financing to support the asset. And the monthly payment to the bank is going to drop $25,000 a month. So our goals: close the HUD loan and then maximize cash flow. So it's a domino effect. You close this HUD loan, and then Q2, the cash flow is going to be there so that we can start turning on distributions.
Yeah, absolutely. Let's see. So significant, yeah, inflation hedge. Yeah, big deal. You can imagine, again, our business plan for this asset that when we all got into this together is a 5-year plan. And so at when 5 years comes around, we'll have this decision to make. Do we keep it? Do we sell it? Is the market right? Can we hit our metrics to the investors and give them what we promise or what we I guess we didn't promise it, but it was a strong, I call it a promise. We see it that way.
Yeah.
But the point is this, when you have this 35-year inflation hedge, so our debt service payment, when we close this loan for the first month, is going to be the exact same debt service payment when I'm 90 years old. Okay. I'm 55 years old, 35 years, I'll be 90. Imagine that. And you can imagine that the rents are going to go up in 35 years. And, you know, um, there's one person on this call, I won't mention any names, has run a graph for me on the effect of that as you get on out that timeline, and it is parabolic, the returns. So what that means is that even if we aren't the owners in 35 years, you have an increased asset value because there are operators like us who seek out properties that have HUD 223F loans for exactly that reason. So not only is our asset in better shape and we have the cash reserve set aside, we have increased cash flow, returns, distributions to investors, but we also have increased the value of the asset just by having this loan. And people will pay for that. They don't have to go through the year of work that we did. They get to buy this asset. Everything's kind of already done. So
And we
that's
do the same
good for
thing
all of
when
us.
we analyze deals, right? Ashley, we're looking at, oh, does it have assumable debt? If so, what are the terms of the assumable debt? Because you get to
Mhm.
plug that right into your financial models, and if it's favorable, it makes it a more attractive buy. So we do the same thing when we evaluate. And so when somebody eventually comes to purchase this asset from us, they're going to see this as a huge win.
Oh yeah. Yeah. And with a 35-year loan, in 4 years from now, we'll still have 31 years left on the debt for somebody to buy and assume. So it's very attractive. Um,
And it's
by the way, we do have there are provisions built in, there are functions built into the HUD loan that you can refinance to lower interest rates in the future. So so we're locking in right now, our application locked us in. Excuse me, we did not lock anything in. Our application was in at 5.5 interest rate. The interest rate we will lock in when we're inside of the 30-day window to closing. So it could be higher, could be lower, but we're looking at 5.5%. But there are provisions for refinancing to a lower one. Say it goes back down to 3.5 again. Well, then we'll pull the trigger and get that lower interest rate. Any questions on that, by the way? This is a big deal. This is kind of, I don't say this is the whole thing, but this is a huge, huge deal. So if you got any questions, let us know.
okay.
All right. So let me get here, Michael. All right. All right. So where are you now as an investor? Uh, we have uh, we have exhibited our operating strength. So our business plan has basically been fully implemented and executed. So all of the things that when all of you became investors, for the most part, this was you were betting on us that we could get this stuff done, right? We could implement our business plan, we could pull off what we said we could pull off. And we've now done that. And, especially in 45 days when we close the HUD loan, we really have done all of that. But the operational efficiencies, the cost savings, things like that have been done. And now we just continue the business plan like we expected for the next 4 years, and we should be right on track. We're up and running, management is there, occupancy is strong, and our revenue growth remains steady and consistent. Um, I'm sure you're all aware that we have not distributed any cash yet, and we definitely plan to do that in 2026. So when the new debt is in place, and that'll be like, again, right around mid-March. So that'll be basically we'll start the second quarter of 2026 with our new debt service. We would expect cash to build up so that we can begin to make our cash distributions to investors. And let's see, we've been through the cash reserves, the HUD oversight. Yeah, we've reduced the risk. And okay, so let's talk about these. And we've got a slide on this at the end about the K1s. We are right in the middle, literally right now, of dialing in all of the 2025 tax stuff. And so you as investors will receive K1s, and those K1s are what you'll use to give to your accountant for the preparation of your own taxes. We would anticipate those being to you probably early to at max mid February. So coming up here in the next couple weeks, you'll get your K1. And we're looking at a range of probably 125,000 to 135,000 on paper loss per every $100,000 investment. So if you invested $100,000, so you bought 100 shares, then you could anticipate a loss on your K1 of somewhere between 125 and 135,000. And let's just follow this example all the way through. If you have the income in the same bucket that you can use that loss towards, and if you were in, say a 30% tax bracket, then you're actually saving in excess of $35,000 in actual cash money from that you didn't have to pay taxes this for 2025. So one way of thinking about it is if you invested 100,000 and you save $35,000 in cash, then you've already made 30% on your investment just by the money you didn't have to pay in taxes. Now that doesn't play exactly like that for everybody. You have to have the correct, income and those types of things. But even if you can't use it right now or use all of it, it doesn't go away. You save that, you use it towards the future income for this property. If this is the only type of income you have, that's fine. But it's a huge deal, and that's as a result of a cost segregation study that we got done, and the 100% bonus depreciation that was reinstated this year to be used specifically for this purpose. Now, I think we've kind of hit on most of this, right, Michael?
Yep, we've covered this.
All right. So here's the specifics on that. You'll never be able to see all this, but this is the page of our tax return that would talk about all of the depreciation, and then which results in the number that comes to each of you on your K1. And we're just dialing that in now. It's got we get the cost segregation study and we have to mash it in with all the CPA stuff. And it's way above my pay grade. But the thing that you need to focus on is that this $125,000, $135,000 loss per $100,000 invested. Michael, have I missed anything there?
No, that screenshot, if anybody wants to walk through that at some point, I'm happy to do that and just guide you through what that's actually saying. But at a high level, what we're doing is that cost segregation study is bucketing assets at the property into different useful lives. So electrical sockets versus lights versus toilets versus concrete all have a different useful life. So a tax expert who specialized in this, they came out to Bryn Mawr Village, they classified all of these things in different buckets, and it allows us to utilize the depreciation in different ways and in many ways accelerate it. So because we can accelerate and we have the effects of the one big beautiful bill where 100% bonus depreciation is back in play with this asset, we get to take a huge amount of the depreciable loss in year one, which is a direct benefit to all of our LPs. So this is even though it's kind of like it's almost too much detail, a bit nuanced on whether you can and cannot use it. If you have other Schedule E investments on your tax return, this is going to be a huge deal for you. So if you want, definitely, I mean, once you get the K1, talk with your CPA. But if you want me to walk through it with you as well, just on a practical level, let me know.
Good. Thank you. Yeah, so we're kind of coming into the end of the recap and the outlook for 2026. And I want to, this slide is kind of a call to action, if you will. So recapping how this thing was set up and structured. We initially set out to sell 8,000 shares. So at yeah, 8,000 shares at a share price of $1,000 per share. That's $8 million. Currently, just within a very fine rounding margin, we've sold 4,500 shares or 4.5 million. We would like to we have revised our total goal to 6 million or 6,000 shares as opposed to 8,000. And that leaves a delta of 1.5 million. So the opportunity from now until the time that we close the HUD loan is for, and we're offering it to you guys first, since you've been with us and been loyal investors. There's an opportunity for one of you or a combination of you to invest an additional $1.5 million, which will take us up to 6,000 shares sold, and then we're going to close the investment. So if any of you have interest in that or know any friends, family, acquaintances that want to be a part of this with you, let us know quickly. I imagine it will go quickly because it's kind of a good story to tell, as you've heard. And I think it will be well received, but we'd love for you guys to be the ones to increase your position if you'd like to do that. Yeah, we've got, these are all our notes, disclaimers, and sources of data. Again, we're always here. Um, if you have any questions or you want to talk about this, we'd love to talk about it. And we appreciate you being partners with us. Looking forward to sending you some checks very soon. And looking forward to, we're always running that number. We get our NOI number in our head. We can calculate these cap rate values almost mentally now because we're just doing it all the time. And this is a fun one because that value is going up, and it's been a great investment so far. We're very excited to close this HUD loan. Trust me, it's a big deal. Michael, anything to wrap up, or if any of you have questions or anything, now's the time to ask them.
Yep, was just going to open the floor for questions.
All right, good deal. Well, we'll take it offline. If anybody wants to talk about increasing your investment position, call us or text us, and we're here if you need us. And if we don't talk to you before, then we'll see you at the end of the first quarter update here in a few months. All right. See you guys.
Thanks, everybody.